Hello and welcome back to my YouTube channel. And today I want to talk about the daily bias. The daily bias in most of the cases is one of the foundation to the profitability. So before you make any trade, before you even decided to go into the market, you need to understand what is the daily bias. Now, daily bias is your directional expectation for the market over a single trading day. So, daily bias tumesema is a directional expectation for the market over a single trading day. It tried to answer the question, the bullish bias. So, when we talk about the bullish bias, you expect the price to move lower. So, you mainly look for self opportunities. When you talk about the bullish bias, you expect the price to move higher. So you mainly look for the buys opportunities. For bearish bias, you expect the price to move lower. So you think mainly for self opportunities. And for neutral bias, you don't have a strong directional view. So you wait or trade only a high probability setup. So daily bias, we say it gives you direction of the market of a single trading day. And to jumpstart this, if you are new, try to subscribe to this channel. Also make sure you like and comment. Let me know what you want me to talk about in my next video. So let's get back into our business. So we have before even we go further, we have what we call IRL and ERL. So what is IRL? What is IRL and what is ERL? So IRL is internal range liquidity and ERL is external range liquidity. To simplify things here, we can look at IRL as a fair value gap and ERL as highs and lows. So if you look at this chart here, IRL is a fair value gap. This fair value gap is internal range liquidity. This is a fair value gap. Well, ERL is highs and lows. So we have these highs of the candle and lows of the candle form the external range liquidity. The significance lies within how this thing operates. The market is in never-ending cycle of analytic between the internal range liquidity, internal range, and external range liquidity. Internal and external range liquidity. You may have also heard of this as the market on the rebalancing sufficiency or reaches for liquidity. We use IRL and ERL to simplify this concept. So we say the significant lies within how, you see IP in the pan price, delivery, and quality. The reason why ERL and IRL is important is because its importance lies within how IBDA stands for in the pan price, delivery, and quality. So for those people who know this thing, this concept was taught by Michael J. Harrelson as a part of the ICT methodology. So this one proposes that the price move is structured in ways to seek liquidity and rebalance the market in efficiency rather than moving completely at random. It's important to note that this is a trading framework used by some traders, not established or universally accepted model of how financial market works. So you need to trade this with utmost cautious. So how do you apply this one? So this, for instance, it is ERL, it is IRL, internal range liquidity, and this one is IRL, which is external range liquidity. The greatest way to apply this concept is to utilize it on the higher time frame and time-based liquidity. This includes, but is not limited to, the monthly, weekly, daily charts. Now, first of all, ask yourself, has the price tapped into a fair value cap, or has the price taken out liquidity? Your next trade is most likely to be the one that hasn't been tapped into yet, either internal or external. So for this case, I had you to use the daily candle. So before you make any entry, you need to ask yourself, has the price tapped in the fair value cap, or has the price taken out liquidity? Now your next draw is most likely to be one that has not been tapped into yet. We also have time-based liquidity. Time-based liquidity. What is time-based? See, every candle has a time-based liquidity. The main time-based liquidity that will be focusing on is the previous weekly or daily candle high and low is the time-based liquidity. So this one. So for this one, we have a candle range there, and this candle will now sweep the above high and close within the range. The significance. So we have reversal. So this is the reversal. So for reversal case, the candle has to sweep the previous high and close within the range. These are called reversal strategy. So the significance lies within how the price usually trades in relation to time. So when we are seeking out continuation in the market, we can look at the previous weekly, daily high and low as a support and resistance. These are the key levels at which the high probability models form. So this first candle here formed the range. The second one sweep above high and closed within the range, giving us a reversal candle, which means we expect the next candle to complete by sweeping the previous low. That is our target. We also have a continuation. We said that this continuation, displacement by previous candle high, specifically for continuation. For this one, it sweep the previous candle high and close above the range. So for it, this first candle becomes the range. The second candle sweep the previous high and close with the body, which means our next market is supposed to be continuation. So ya kwanza is a reversal because it sweep above the previous high and close within the range, while this one is continuation because it sweep the candle sweep the high and close with the body. Application. The way that we will be implementing this concept into developing daily pairs is by referring to time-based liquidity. When either internal range liquidity or external range liquidity have been rated into. So in the markets, you are expecting two things: reversal or continuation. I have to learn. It's either reversal or continuation. We have also we have also lower time frame. Lower time frame striker. Now that you have determined your daily price on high time frame, that is where lower time frame model have high probability of working. From this key level, from these key areas of the high time frame, this is where a high probability market maker model form, thus making lower time frame model extremely effective. By framing our lower time frame structure of the HTF or high time frame level, we are no longer afraid of retracement in the market. Rather, we look at this retracement as opportunities to add to our position, either buy or sell position. So at this one, this is original consolidation, this is accumulation, and this is reaccumulation, and this is our first entry. You end area, and then distribution, you put another second entry, redistribution, another third entry. So our daily bias in lower time frame help us in adding our position. Hope tunaelewana. So your first entry was here, your second entry is here, your third entry is here, which means for the second entry you'll be using the profit of the first entry as your stop loss. So in case the market goes against you, you are not risking your capital. The third entry, you are risking the capital of the second entry. So in case the market goes against you, your account is still safe. Hope tunaelewana. So if you have an issue, look, you can stop watching and try to understand. Try to get this thing before you even open your charts. Try to understand this thing. So when you have mastered this thing, your trading look easier than you think. Another step 4 is the opening price. We call it optional confluence of or the power of 3. Further confluence to confirm bias is to use the opening price of the weekly candle or the daily candle. The opening price that you'll be paying attention are weekly opening on Monday or daily opening at 00 midnight. We can refer to this price level as time-based premium discount. We can refer to this price level as the time-based premium and discount. If bullish, it is ideal to enter long below the opening price and vice versa. If bearish, it is ideal to enter short above the opening price. So if bullish, you're supposed to enter long below the opening price, not above it should be below the opening price. Help to the one. If it is bearish, you enter above the opening price. So this is how it's look like. So you say this is the market. It's come here. Then you're supposed to look for buy position here before the market move. So weekly daily open price is here. So you're supposed to enter at somewhere here below the opening price, not above nor above. It should be below the opening price or the discount zone. Example, internal or external. The first step is to identify whether the price is trading into the internal or external range liquidity. On this is determined, once this is determined, we can begin to have an expectation in mind. In this example, we are going to study how the price trade from internal range liquidity to external range liquidity, as shown below. Now, the price trade into the fair value gap, which in our simplified terms is internal range liquidity. So for this one, we have the equals highs and the equals low. Also, we have our own fair value gap here, which is internal range liquidity. So for this one, the price tap into our internal range liquidity before moving. So we say the market has to tap either of these two, either internal range liquidity or external range liquidity. Another one is the displacement or manipulation. The second step is to identify whether the price is okay, before I go for the second step. So when this one tap our internal range liquidity, we're supposed to look for the distribution or the displacement. So the market has to tap our yield level or our either internal range liquidity or external range liquidity for it to be a valid. And this one form, we call it manipulation candle. The second one is displacement or manipulation. The second step is to identify whether the price is displacing past the previous weekly or daily candle, or if it is just sweeping the liquidity of the previous candle. In this example, we can see that the price begin to struggle closing above the previous candle highs, which help us to identify that the price may be seeking the lower price. We are focusing on the down close candle immediately after the up close candle, because we need to make sure that the previous candle failed to displace the high. When this is confirmed, we can begin to anticipate for the lower time frame structure to present the bearish. So for this one, the candle has to sweep the previous high and close within this range to confirm to us that the market is actually bearish. You're supposed to wait. In trading, it's a matter of waiting. You wait like a sniper. Without waiting, you end up losing money. So I always tell my traders or those traders who are working under my guidance, try to practice waiting. So in this case, the market sweep the previous high and close within the low, and that candle confirm by tapping opening of the price and displacing to our previous low. Number 3, the lower time frame striker. The step 3 is drop down or lower time frame relative to higher time frame. We are looking at it. So for entries, you are supposed to switch to lower time frame for entry. So in this case, from the lower time frame, we are looking for a bearish structure to present itself so that we can find the carriers within this structure to enter the short position. Within this lower time frame structure, you will be able to spot with this lower time frame structure, you will be able to spot what You'll be able to spot the market buyer model or the market maker seller model. Now we have this term. So look at this one. We have the opposite bias example. So the market was buying. Then from here, you look for the market structure. Then you look for entries. So the market was actually been on a bullish trend. Then from here, there is a change of structure. I'll explain that in my next videos. We also have the market strategy, which shows that the market has changed the direction. Then you look entries from here. To learn more about market structure, I'll I'll make my next video, or I'll talk about market structure in my next video. And for now, class, my advice for you is understand, try to understand this thing before you enter the market. Especially, the market has two options. It's either continuation or it's either reversing. So that is the best thing. It's either continuation or reversing. Now, I think class we can end there for today. But make sure you like, subscribe, and comment. You like, subscribe, and